Brian Lysing. I'm a life insurance sales director at Financial Brokerage. For those of you not familiar with Financial Brokerage, we're a national life insurance, annuity, long-term care, and disability marketing organization. We work primarily with independent producers all around the country. And I want to thank you for taking a few minutes out of your morning to join us here. We're going to discuss the high deductible survival plan, and that's a term that that I coined to describe a way that we can use a life insurance policy to help clients that have high deductible health policies potentially pay that deductible if a major illness or health event happens to them along the way. And I thought this would be a good time to present this, as those that have been involved with the health insurance enrollments have just ended that for the most part, and now have opportunities to look at other products and other things you can help your clients with as we move on through the year. As I mentioned, this idea pertains particularly to folks that have got high deductible health insurance policies. That's the market this is going to be geared towards. However, the product we're going to be talking about could really be sold to anybody. This is just one real easy use for this. Here's the problem we have. A lot of people with the new healthcare law have health insurance. A lot of people who never were able to purchase it before because they were uninsurable, or because the premiums were so high, they now have subsidies to help them pay the premiums. As a result, we have, I don't know, somewhere north of 10 million more people insured in this country for health insurance than we've had in the past. Catch to that, though, a lot of these plans have very high deductibles. And what would happen to one of your clients if they had a major illness strike? Let's say they came down with cancer. Their first treatment, they're probably going to hit that deductible in one day, maybe 1 week. Now, there's a reason they have that high deductible. They don't have a whole lot of money for a lower deductible. So if they don't have the funds for the lower deductible plan, chances are they don't have the money to be able to pay that high deductible all at once. Over the course of a year, yeah, maybe, but not if it hits them in 1 day or 1 week, like might happen with a major illness that they experience. We also know a lot of folks in this country need some life insurance. In fact, the numbers from LIMRA back that up. About half the people in the United States have no personally owned life insurance. Some of them might be relying upon employer-based care, but the employer is certainly under no obligation to keep offering that as a benefit. And if they leave employment, they may or may not be able to take that coverage with them. Oftentimes they are not able to take it, or if they can, the price is so high that they're not financially able to do that. So we know there's a lot of people that need some life insurance. In fact, even if we look at the other half of the people that have some life insurance, half of those, according to LIMRA, don't have enough life insurance. So why not put these two needs together into one product for our clients? What if a life insurance policy could do more than just one thing? What if it could not just offer a death benefit, but also offer a living benefit that has the potential to help our clients in the event that they have to pay the deductible on their health plan all at once? Well, here's what we're talking about. It's a critical illness accelerated death benefit rider, and a few carriers have decided to place this on their term life insurance policies. And what it allows the client to do is to actually accelerate part of their death benefit while they're still living if they've had one of these events. And every carrier has their own listing of events. These are some of the major ones that you see on most of the policies. As I mentioned earlier, what if they're diagnosed with cancer, they have a heart attack, a stroke, they need an organ transplant, they've lost some limbs. Any of these major events will trigger this benefit to pay out. Here's how the pricing works out. I plugged in numbers for a male 40 preferred plus non-smoker, $500,000, 30-year term. If we look at just the lowest cost product on the market right now, Protective comes in at just about $54 a month. American National, who offers a one-time living benefit, is about $1 more. If you're looking at just those two, why wouldn't you sell the American National over the Protective? It does give a client at least a one-time benefit. Transamerica is right in there. Their base policy is still just about $1 above the lowest price out there. I bet you if you change the client's age by a year or two, change it to a female, change the rate class a little bit, these companies will be rejumbled up and somebody else will be on top. But bottom line is, in this case, we're looking at about $54, $55 a month for this person if all they purchase is a term policy. Now, what if we want to give them a living benefit they can use multiple times? Transamerica comes in for just about $10 more per month and has their living benefit available for this person. So it doesn't cost much more at all, and in some cases, it's a negligible difference. Here's how these policies pay out. This is one example. I pulled this from, I'm not even sure which carrier I pulled this from at the moment, but this came right out of an illustration. And this will give you an example of what a person might expect to receive if they have one of those qualifying events. So we took that same 40-year-old and we said, well, what happens at age 50? Maybe the person gets cancer. And at that point in time, the company is going to do some underwriting to look and see what that condition has done to their life expectancy. And they may categorize that person's condition as a minor condition, a moderate condition, or severe. Now, here's the good news and bad news. The bad news is the more severe your condition, the less time they think you have to live. Good news is you're going to get a lot more money. And conversely, if it's a minor condition, they won't accelerate as much to you at that time. You'll never really know exactly how much you're going to receive until the person actually files the claim. But the nice thing about this illustration is it gives people some sort of guidelines to look at and an example of what they might expect depending on the severity of their condition. So it's nice to know what you might be getting back out of this policy. I mentioned some of these carriers earlier. We actually have 3 carriers here at Financial Brokerage that offer some sort of acceleration for critical illness on their term policy. I'm going to start on the far right. I had mentioned American National. We saw them in a comparison earlier. They don't charge anything extra for this rider at all, and sometimes they're pretty competitive with their term insurance. Their rider is rather unique. If you choose to exercise that and take the acceleration they offer, that will end your policy. If you had this $500,000 policy, maybe they'll offer you $200,000, or maybe it's $100,000. If you take that, you have no more life insurance left. You might live a long life. You might still have a need for that coverage. If you've had this major health event, you might not be able to qualify for coverage again. So you might think twice about taking them up on their offer. If you really need the money, though, you're going to take it. So, you get what you pay for. They don't charge anything for the rider, but it does end your policy if you accept that. Now, the other 2 carriers, they don't work that way. They will allow the client to take multiple accelerations if they have multiple events. Accepting the acceleration does not end your policy. In fact, the example we saw on the previous page, I mean, a person could have a claim at 50, you could have one at 60, you could have another one at 70. And let's hope the person isn't in that poor shape, but it could happen. A couple differences here between Transamerica and National Western. National Western, they offer this as a non-med or simplified issue product. So there is no paramed exam required. Most of these non-med products are priced accordingly. So you're going to see pricing that is equivalent to a Table 2 or a Table 4 rate class, somewhere in there. And the face amount, if I remember correctly, is capped at $250,000. So it's going to be a smaller policy, and you're going to pay for the lack of underwriting in the pricing. Transamerica's product, you can purchase that up to $1 shy of $1 million. I think it starts at $250,000 of face amount, and that's fully underwritten. So if you have a healthy client, all of their the very best rate classes are still available for the client, and it is very cost effective. They allow for multiple accelerations, and again, accelerating with Transamerica does not end your policy. So now that we know who to contact, we want to talk to the folks that have got high deductible health plans and either have no life insurance or they don't have enough, which is at least 75% of the country right now. How do you plan on getting in touch with these folks? You might have clients already if you sell health insurance. You might have a list you want to use, do a mailer, do some sort of marketing campaign. Well, if you're contracted with us here at Financial Brokerage, you're welcome to use a piece that our graphics person here has created, and here's what it looks like. We have an option to put your name and contact information at the bottom. This is actually listed as a postcard piece in our Every Door Direct Mail lead program we have on our website right now. We have this in PDF format if it's something you would want to email to your clients. We have a system that can help you with that, or of course we could put your information on there and send you the PDF. You could have it printed and mail it out if you want to do that as well. So, but this is one piece you could certainly use as long as you're contracted with us to try to garner some interest on this product. So there's really no reason to make your clients wait until they're dead to benefit from their term life insurance policy. If you're selling term insurance to them, you might as well offer term. It gives them an opportunity to utilize while they're still living as well. So that's the webinar this morning, and I want to thank everybody for attending. If you know of someone who you think would benefit from this information, I'm going to be presenting the same webinar again exactly 2 weeks from today. And then you'll also want to catch us exactly 1 week from today when Dave Stork will present the next in his advanced planning series here with life insurance.